Welcome to this update for the Ftse 250, and I'm also going to be going through some macro data. Please remember that this is for entertainment purposes only. So obviously it's been a very exciting few weeks, but actually the Ftse 250 is only down about 7% in that time. But the Ftse 250 seems to be in this technical pattern that I've been monitoring for many months now. And I kind of feel that as the craziness goes on with all the tariffs and everything, we'll see a volatile situation, but within this trading pattern. And then if things get really bad and kind of worldwide recession and stuff, I'd expect to see us break south of this triangle. But I think there's actually a good chance that we'll end up, after a kind of turbulent time, breaking out on the upside. And I do wonder generally if we might see US stocks underperforming the rest of the world for a while, and UK stocks actually doing well in comparison. So going on to this longer term chart, for a long period of time we had a certain gradient for the Ftse 250 which coincided with classic Keynesian economics, but we used to get these kind of these boom and bust cycles. Then ever since the credit crisis, we entered the era of new Keynesian economics where there was lots of money printing used in conjunction with interest rates, and we saw the gradient increase following the year 2020 when actually even more money printed started going on. Whereas the US stock markets went roaring into massive new highs, we entered this extremely kind of stagnant period, as did our economy. And then we're currently had this Trump dump. I did a video a month ago where I explained what Trump was going to do. And then 5 days ago, I did this S&P 500 and macro update where I give a kind of update on that. So for information on what's going on at the moment, take a look at these videos for all the details. But briefly, Trump's trying to change the economics of the US from a globalist new Keynesian economics model to a economic nationalism model. And as far as we're concerned with the Ftse 250, I'm expecting chaos within this technical pattern. And if things go really bad, if we get like a layman's moment or something, that will affect us. But I think there's a good chance we go for the upside. So for me, it's very clear that it's time. The time at the moment is the time to start getting together one shopping list for what stocks to invest in with cash on the side, and basically wait out what happens. And I've got like a nice trading pattern here to help me. I think that actually the bottom of here would be a good time to perhaps be buying, but there's no need to rush, and it's kind of better to see which pattern emerges actually before substantially moving into UK equities. That's just my cautious approach. I'm actually currently only 24% in equities, of which 14% are gold equities anyway, which are fairly defensive. So there's going to be a number of months to watch this play out for me. In terms of the Ftse 100, I don't actually use this much because only 30% of the revenues from stocks in the Ftse 100 are from within the UK. So it's actually more of a barometer of the world economy than anything, and it tends to just adopt this carry on regardless trajectory. So I don't really use the Ftse 100 index much. But we would expect, obviously, if you look at like what happened in 2020, we'd expect it to sharply drop, and then as the as the world drama recedes, move back up to its kind of carry on regardless line. Presumably, if there's permanent damage done to the world economy, then you'd see it carry on regardless, perhaps from a lower level and at a shallower trajectory. So I've completed now my analysis for the Ftse 250, and like I say, I think we're in a trading pattern. Time to sit back and get my shopping list together. Now I'm going to move on to the macro data. But of course, we've had a sudden change in the world following the Trump dump and all of these trade wars going on. So please remember that all the macro data is actually backward-looking data. You have to wait several months before you get the current numbers. Here I've got the interest rates, GDP growth, and inflation, but only updated on a yearly basis. But then I've put the current numbers here, and we see that interest rates in black have been higher, but actually kind of a historically normal level. Inflation is 2.4% currently, according to my estimate, but that's still kind of like a highish number. So, and yet when you look at GDP growth, the current estimate is 1.5%. So you can see that following all the chaos from 2020, we've had a kind of stagflationary situation in the UK, and the economy is still looking weak, and we've got kind of sluggish GDP growth, but still inflation sort of normal. So it's kind of a weak looking economy bordering on stagflationary. But unemployment is actually really low, actually at about 4.4%. And then here I've got the headline numbers. So we've got low GDP growth at 0.6%. That's according to my estimate. Kind of normal inflation, so a kind of sluggish stroke, slightly stagflationary kind of situation. But we do have low unemployment. Obviously, the stock markets have just gone haywire, but house prices are actually doing okay. And here I've got the government debt and fiscal deficit, and they're at kind of historic highs, but stable. So here I've got my quarterly inflation data. Most people like to use the year-on-year inflation numbers, but I don't think that's very useful data because it's comparing with a year ago. I prefer to use CPIH month-on-month numbers, and then I package them into quarterly data points to come up with this graph, which is what I'm using for my GDP estimates. And currently it's on the lower side at 0.4% in the most recently updated quarter, but we had some high prints as well, so we're kind of not out of the woods yet in terms of inflation. And like I say, we're kind of stuck with normalish inflation but lowish GDP growth. So I was talking about the world economy being one of new Keynesian economics plus recent experiments with MMT. And that's how I visualize this with the government tools there to meet their objectives. But the money printing and relatively low interest rates, despite having fiscally loose economies, has only been possible because that would be kind of inflationary, like money printing and artificially low interest rates. But it's been enabled by deflationary forces, particularly technology, the growth of the internet, and the globalization. So currently things were kind of in balance, but the question is, what's all this? What's the Trump dump going to do? How's that going to affect? Is it going to cause inflation? Will there be inventory surpluses, which will be deflationary? I'm not sure. If there's a world recession, that of course will be a deflationary force, and then that may allow the UK government to lower interest rates. Eventually, if we start using AI bots, that will be a deflationary force, perhaps one to replace the globalism. But still, obviously, this is all very unclear, and we need to wait for patterns to emerge. The other thing is, let's say there is a world recession and then a recession in the UK. The government can only lower interest rates and put some boost burners down here to if the pound sterling is holding it together. And so that's why I like to look at yield curves. But unfortunately, we see that the yields have risen sharply on the long end in the last few weeks. So actually, the pound sterling's under a little bit of duress at the moment. Like I say, we need to wait to see the patterns emerge before we can start reading into this. But I'd say it's certainly not a time to go rushing in buying stocks. So, okay, here I've got my actual monthly updated data, so you could perhaps screenshot that if you like. But just to run through this, obviously interest rates, the next decision is going to be 8th of May. It's not so clear looking at the yield curve whether the Bank of England will be able to lower them. Quantitative easing, and apparently the bank plans to keep on reducing that all the way through to September by 100 billion. Inflation numbers, obviously I like to package that data using this representation, but if you look at the month on month, we see that quite often we had high numbers, inflationary numbers, and then we just had a high number in February, which would actually map out to over 4% a year just on that data point. So a cautionary outlook really for inflation. But like I say, this is backwards looking data, so it'll be interesting to see the April numbers following what's happened. House prices looking great actually. Real GDP has been sluggish, kind of weak overall, but not too bad. But then we just got a negative number in January. Unemployment's the only bright spot at 4.4%. And government debt and fiscal deficit kind of the same as with this chart here, stable if at historic highs. So here I've got the FTSE 250 up against GDP and the extent of quantitative easing and interest rates. And you see the interest rates are kind of at a historical norm. Quantitative easing is obviously a historical high still. So a lot of people are expecting recession, then interest rates to drop, and then GDP go up. But it's possible that if the pound sterling is looking under duress, they won't be able to lower interest rates, and it's a bit. We're just going to have to wait and see what happens. So this is the fiscal deficit and government debt, but done on a closer timescale, where it kind of looks like it's getting better as it does with this fiscal budget graph. We're not healthy, but improving actually. But when we look at government debt, yes, it's the same. It's tracking GDP, but the problem is it's going up. How long can the government keep on sustaining that for? And here we've got government receipts versus spending. As you can see, it's spending more than it's got coming in as taxes. Here's the government spending as a percentage of GDP, which is kind of at historic highs. So we've got a very socialist economy. And here's retail sales, a percentage of GDP, which looks very stagnant. But it had been looking like it'd be going to be recovering. However, maybe that's going to be nipped in the bud by recent events. So these things are behind a paywall as of this update. So I'm going to have to find a new data source, but it's long-term data anyway. And you can see interest rates where they are kind of even on the low side historically. So if things start going really bad, interest rates coming up here. So be prepared for that. Unemployment though is historically very low, and inflation is kind of historically normal at the moment. House prices, you see, seem to be in this trend. Now, GDP and M2 money supply, it's kind of a bit worrying. M2 money supply, that's behind a paywall. So actually, I've got here a more up-to-date version. It's kind of a bit worrying actually to see M2 money supply dropping, because if it keeps dropping like this, that means things like house price crashes because the banks aren't able to lend, things. So I don't like seeing the M2 money supply drop for the UK. This is a concern, and GDP is up, up here, and we need to keep track of this. because if GDP drops, that's a bad sign. Here's public sector net debt as a percentage of GDP. As you can see, we're not really at a healthy number. So I looked at the exports and imports for the UK to try and work out how we can be affected by all these trade wars. Now, actually, if the tariff wars are going to cause a recession in China and the US, then that will hurt us because 25% of our exports are to either the US or China. So it is actually potentially going to hurt us if the US and China have a trade war with each other. The thing is, though, if we're trading with the rest of Europe and China without tariffs, and it's only the US that is kind of hurting itself with tariffs, it'd be interesting to see how that turns out. And so then I started to think about services because, this is all these tariffs about goods, but actually a lot of the GDP is created by exporting services. And what I found was actually roughly half of the UK's exports are from services, which makes us different because the rest of the advanced nations actually have most of their exports are goods and only a minority from services. So again, this makes me wonder, is the UK potentially going to be doing very well out of all this trade frictions in the world? Because we are actually configured quite uniquely here when you look at the top 10 nations, could we end up being a winner out of this? And so then that takes me full circle back to my technical pattern I've drawn here. And I'm wondering, once we get through all the chaos, it'd be interesting. Got the beginnings of a kind of pet theory here that maybe the UK could be benefiting to how the world ends up, following the effects of Donald Trump trying to reconfigure the US economy from one of globalist new Keynesian economics to one of economic nationalism. Okay, so that completes my video for the FTSE 250 and the UK macro outlook. I hope you found it useful and speak to you at the next video. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.